call market data adapter. So all the data, whichever is coming on the broadcast or tick by tick, that is being handled by this adapter. So this is converting and this storing the data. It can store or it might not store. Next part is your CEP. That is the complex event processing engine. The CEP engine, that is where all your strategy calculations that takes place. So you are say building a technical analysis based strategy, say moving average strategy. So whenever 20-day DMA process 50-day DMA, you buy and vice versa. So all those calculation of calculating 20-day DMA, calculating 15-day DMA, calculating whether it has crossed. So all of that will happen in CEP. So this will give it data as and when it gets in, and this will do all the calculations. So based on the calculation, you will there will be a part of code in this where you will be saying if this is the condition, then you send this quantity ka order in this stock or commodity at this price. Okay, so that you will be generating an order, and that will go to OMS. So that is, or ORS, whatever you call it, order routing system or order management system. So that is where your order routing adapter sits. So that is another adapter which converts that order, which is in your own proprietary language, proprietary system-based language, and it will convert it to the language that exchange can understand, on fixed or native, whichever, and it will send the order. So this is a typical diagram for an algorithmic trading platform. So any platform you take it, be it Omnisys or TCS or FlexTrade or Abama, all of them would have this kind of structure, right? So now for this, obviously you will need these can all be done only in the servers. So you would need some servers. Everything is on lease lines. Algorithmic trading is only allowed through lease lines. No, not through VSAT, neither through internet trading, IVT. So that is not allowed. So then you can have your servers either in your own location or in colo. So what do we mean by colocation? Colocation is putting a server into the exchange's premises. So on the exchange's LAN. So the server is on the exchange LAN, so it becomes, the latency is reduced. So if I am sending order from Goregaon, so there would be about 3 millisecond latency. By latency I mean how much time will it take for my order or my data, whatever, to reach the exchange, right? So there will be about 3.5 milliseconds latency which would be there. If I am sitting out of say Delhi or say I am sitting out of Kolkata, it would be somewhere around 55-60 milliseconds because data travels at some speed, and which is less than speed of light. So definitely there will be some time which will be taken, right? So by placing your server in the colocation, you are on the exchange LAN, 1 Gbps or 10 Gbps, whatever the second critical thing is, so for this obviously there are almost all the exchanges are providing colo facility now. NSE has it, BSE has it, MCX, SX has it, MCX has it, but it is in still, it is not in LAN. So it is still on the lease line, so which will be 2 Mbps or 10 Mbps, whatever line you have taken to the exchange. So it's still not on LAN. They have not got the approval from FMC for that. So they are expecting it soon. So once that is there, so the colocation with MCX will also start. Okay. So so the second thing is the data. As I was mentioning, tick by tick data. So again for that you will need lease lines. So either you can have it in colocation, or you can have it in your own premises. So I am sitting here in Goregaon. I can get a dedicated lease line which would be tick by tick lease line, and the typical strength of the lease line is 400 messages per second. Is the T1 is a T1 category, but it overshoots quite a bit. So the overall ticks, if I can say, it would be around for equity for the CM net put together, I guess that would be around 11,000 to 12,000 ticks per second. So that is huge data. Obviously, it cannot be managed in that kind of capacity. So what happens is you can subscribe to certain scripts that okay, I want to listen to only 50 scripts, Nifty 50 I want to listen to, and the data will be provided to you only for that, those 50 scripts.
11,000?
12,000. It would vary. In the morning it would be different. In the opening session, the closing session it would be higher. During the day it would not be that high. But on an average, 10-12,000 ticks per second.
ticks.
So that you will be getting on T1. So that's T1 segment. Okay. So for that, if you are in Polo, even then you need to have a lease line, but that is more of a cross connect. And if you are sitting out of your own office, in that case, you need a lease line. So on that, you can get the data. If you want me to go into more details, like it is further for NSE, I'll tell you. NSE has 3 segments: CM, FO, and CDS. Right? CDS is currency and currency derivatives, currency interest rate. FO is future option, CM is capital market. So if you are outside the co-location, in that case you will need separate lease lines for each of the segments. Okay, for tick by tick. Oh, sorry, for tick by tick. And if you're in co-location, you get all the data on the single lease line. So that is the one difference.
Depends on the protocol also, no? What protocol?
Protocol would be TCP/IP for tick by tick.
Because NSE provides an X25.
Sorry?
X25 protocol.
X25 would be, I think, for the broadcast. Right?
Only for the broadcast.
So for the UDP, they will be providing it through that, and for X25, and for T1 it is typically TCP/IP. So for TVT, normally for broadcast you do not need to log in. There is no login session for that. You just need that connectivity, and the whole of the data would be available on all of your network on that particular line. Okay. For tick by tick, you need a login. So for cash, CM, FO, CDS, everyone, you would need to log in into the exchange, even for data. So that is there. And then the third thing is, you will need lines to send the orders. Right? Even for sending order, you need some line. So there is one E2 line, E1, E2, whatever. There are different variations for this. So A category line is 40 message line in NSE. So where you also receive the broadcast data, and you can also send up to 40 orders per second, 40 messages per second on that line. That is for NSE. For MCX, it would be, they do not have all these differentiations. They simply have one line which comes to you, and the capacity of the line is different. It varies from 8 to 20 typically. Okay. So 8 messages is the minimum that you will get per second, and maximum, if you upgrade it, you can go up to 20 messages per second for MCX. There is no concept of TPT on that so far. Same with MCXSX. MCXSX, there is probably the limit on sending orders per second, messages per second is much higher. That is okay. So that is one is A1, A2 line, A category line, where you can send up to 40 messages per second. Then you have B and C categories. B is 100 messages, C is 200 messages. So you can, this is the maximum orders that you can send in a second using the C category. Beyond that, your orders will not be entertained by the exchange. It will just queue up in the queue. So for this, you will need a lease line. This is the setup. Your servers are there. You can have them in the Polo, or you can have them in your own premises or in some data center. Right. So that's most about the technology. And there are certain innovations that keeps on happening. Like people are now even moving towards getting their strategies coded right into the hardware. So there is no concept of operating system, anything, nothing like that. You just program the chips into the hardware, and they will run the strategy itself. So that's like super fast. So basically race to zero, we call it in the terms of latency. So that's there. And since I'm covering latency, I'll also tell you that latency, you have two sources of latency. One is external, second is internal. So external would be where your server is located, and from there it has to travel to the exchange. So that will take some time, right? So that time taken, that is not in your hands. The only thing in your hands is where to place your server. So you can go for Polo, or you can go for some more location which is more proximate to the exchange. Second is internal latency. So that is system latency. So that is once you receive the data to the point you are sending the order. So this duration, this is where the system latency comes into the picture. So for a typical very low-end algorithmic trading platform, it would probably go up to few milliseconds. So it can even go up to 5 to 10 milliseconds. For better systems, the moderate ones, this number would be somewhere between 100 to 200 microseconds. And for hardware thing that I was mentioning, so that would be somewhere around 50. And if you do furthermore innovations, right now the lowest latency claimed in public is by Deutsche Systems, so not in India. So that is around 3 to 4 microseconds. They are like extremely fast. This whole process takes. The colo would be the external part. System is within the system. You while you are converting your data, the market data using a reductor, reading it, applying your strategy, building an order, creating an order, sending it across. So the point it leaves your system, from the point it entered your system, the market data entered your system. So that type you're talking about.
This hardware usage is 100 to 200 microseconds.
No, for the good algorithmic trading platforms, normal algorithmic
If you
trading,
go through an hardware device,
then it would be sub 50, less than 50 microseconds. And if you do further innovations on that, it can go up to 2-3 microseconds.
What is the kind of hardware?
Typical Xeon 5690 Intel, that 16 GB, 32 GB RAM. That is a typical hardware. If you're going for co-location, you would go for blade servers because that saves up the space. You can have in much lesser space. You can have many servers. If the performance is the thing, in that case, if you want to do some hardware enhancements and all those things, then you would probably like to go for rack servers because in blade servers there is not a lot of scope to do much innovations because of the space constraints. Right. So it depends on the requirement.
So you mean to say 2U instead of 1U?
no, blade and rack are totally different types.
Okay.
And
Blade way you have a chassis in which you can have like typical. Right. Yeah. So typically in a rack you have 42 unit rack, right? And they also provide you half rack, so that would be 21 unit. That's the standard size. It can vary from exchange to exchange. So 21 unit, and in this either you can dedicate one half the complete half rack to the blade, and other half you can use for routers and everything. So here you can go up to 14 to 16 servers. Okay. And if you're going for rack, then probably you can go till 5, 6 max. So that depends on the requirement. If you're looking for scale without overshooting your cost, then you will go for blade. If you're looking for scale and performance and everything and innovations, in that case you can go for hardware. Say you can go for full rack or multiple racks with the rack servers. Right. And then again there are a lot of things that we provide consultancy on the advisory side. So that is where we further bring down the latencies and everything. So there are a lot of modifications and manipulations you can do in the hardware that can and in the network that can help you in getting the better latency. Okay, so this is
How do you measure the system latency?
there are programs for it. You can build a program.
Okay.
So that you can do it by coding in the system.
Now, one thing, like, when you're talking about CEP, basically when you're talking about algos, now in this, normally based on the market which immediately the trades and the strategies are built in, they're all.
You will be building the strategy. So you will be building the strategy on the CEP.
Yeah. So what I was asking was, do we need to take the backdated data also and store it?
You can do that.
You
You can do that either in this server itself or in this server, or you can have a separate database. That's totally okay. Typically, you would not like to mix the database server with the market data server because that slows down the performance. Again, there are different ways on which level you want to do it. You want to store the data at the cache level, or you want to store it properly into the system in the memory. So if you are doing it in the memory, if you need some data which you can pick very quickly and it does not take a lot of time, in that case you would like to put in memory.
Because in this particular scenario, maybe the latency will increase, right? For example, if I'm having another server,
Yeah, it is not increased. That's what I'm saying. If it is not too complex, then you would probably like to use the memory of the CPU. And so you typically go for high L to cache memories and all those things while going to the servers. Right. So that's the most about the technology, typical how algorithmic trading system would be set up on.
and one thing you told, the hardware skill, okay, it should be zero servers and all those things.
Totally up to you. It can high or whatever. Yeah.
And anything related to the connectivity also needs to be increased?
You will have like, these are standard ones, so 2 Mbps, or you can have more capacity as well. Typically the exchange asks
Exchange offered lead lines will be fixed, you can't change
Yeah,
that.
that you can not change.
Yeah.
That would typically be 2 Mbps. So typically, can you tell me how does it, when you are building a strategy, what are the various steps that you take for building a strategy? First idea would be, how do you think about new strategies? Well, let's go to ideation. How do you think about new strategies?
Depends what are we looking for, whether we are looking for something kind of arbitrage, which kind of things.
Decide upon the genre or strategy. Right. So R or alpha or simple execution, which would be typically be the execution strategies, or H. Right. Okay. Next. Once I decide that I want to go for alpha. Alpha मैंने decide कर लिया now. So alpha strategy basically where your motive is to make money irrespective of the market movement. So whichever market is moving, you want to capture the alpha. Right? Alpha is, should I go into detail on that? What we mean by alpha strategies? Right? Okay. So typically क्या होता है in a normal CAPM model. So we have for returns of a particular security, say returns for Reliance, would be, as per the CAPM model, would be this return of Reliance minus risk-free rate of return should be equal to alpha of Reliance plus beta of Reliance multiplied by return in the market minus R. Right. So this part would depend on two things. One is what is the return in the market and what kind of correlation does this stock have in the market. Right. Second thing is alpha. So that is irrespective of the market, how is this stock performing? Right. So the idea is to capture this so that even if the market is going up or going down, so that's the idea behind the notation alpha strategy. So I decide कि okay, I want to build an alpha strategy. Say I even decide कि I want to go for a pair trading strategy, which is a mix of alpha plus H. Okay. So now what? What should I do? If you want to do a pair trading strategy, what will be the next step? Create a model.
Where you will be quoting and where you will be hitting.
Where you will be quoting and hitting. Okay.
Which is the pair, in that pair where you will quote and where you will hit.
Okay. You saying something?
Same thing.
Identifying the pattern first. And then
Identify the pattern. Interesting. So more or less on the correct lines. What we typically do is that once we decide कि okay, I want to do a pair trade, I also decide on two things, two slips between whom I want to build a pair. So if I want to do a pair trading, say I'll take a typical example of USD INR versus Nifty. Okay. Now this selection would be based on more of my logical thinking or my experience in the market or the visual correlation. So I see daily in the newspaper that whenever USD/INR is going up, market is going down, or market is going up, USD/INR is going down. Right. So there is some visual correlation that I have seen, and based on that, I want to establish this relationship. So first thing would be establishing the relationship using the statistics. So how will I do that? I will calculate the correlation or better co-integration between these two scripts or asset classes. So I'll establish the correlation or co-integration. So once I establish that, I would know that okay, to this confidence interval, this thing is these two stocks are interrelated. There is some relation between them. Right? Once I have established that, next thing would be building a model. Right? So I'll be building a model. So to build a model, what I need to do is I'll have to create an index kind of thing, which is mean reverting. Because pair trading, when you are doing pair trading, you are doing mean reverting. What is mean reverting then? Mean reverting is something which is, so I want to create it mean reverting, and furthermore, it would be even better if it is reverting across a straight line. So more of a sinusoid kind of thing. Right? So I'll have to create this index. For that, what I'll be doing is I'll be using my statistical knowledge, econometrics, to build this kind of index which can be traded. So typically what I'll do is that I'll take the prices, I'll calculate the moving average, subtract the moving average from it, so that mean is gone. Now I have just these ripples which are there. Before that I'll take a ratio or difference between both of them, right? So all of that, after doing all of that, I'll have something which should be mean reverting if it is going above say 2 sigma, 2 times standard deviation, then I'll probably sell. If it is going minus 2 times standard deviation, I'll buy something on those lines, right? So that will help me build a model. So I'll get something which is predictable, right? So that is the next step. Now comes the thing that whether it should be a quoting strategy or a hit strategy, right? So when I say quoting strategy, a quoting strategy is where you are, I decide that I want to quote in Nifty, so I quote in Nifty, and whenever I receive a fill, I get an execution in Nifty, I'll send order in USD/INR, right, to cover. Now that can be market order or limit order, which I can keep on modifying using some algo or something, right, that I can do. So that is the quoting strategy. Hit strategy is, that is liquidity taking strategy. So what you will be doing is that you will be sending market orders or simultaneous orders in both the assets, right? So if I am sending that, so I will be paying bid ask on both of them. So I will be selling at bid, buying at ask, right? So I will be paying bid ask. In this case, I am saving bid ask at least on one side, right? But again, there is a lesser probability of getting a fill, right? If I am sending market orders, I will definitely get a fill, right? In this case, there is a reduced probability. So it's just a game of optimizing between getting the probability of fill vis-a-vis getting the optimized execution and the time execution. So slippage and time execution. So these are the 2-3 things between which you typically optimize. Next thing is, say I decide that I want to quote. Okay. I have decided that I want to send quotes in one of them and then cover the second line. Which one should I quote? Should I quote in Nifty or should I quote in USD?
Whichever is less liquid.
Okay. Definitely. So the first thing is liquidity. So I'll look at liquidity. If Nifty is less liquid, then I'll quote in Nifty. If USD/INR is less liquid, I'll quote in USD/INR. Fair enough. I'll tell you a catch in this. This is what you should do typically. But there is a catch. If you want to do a lot of trades, in that case we are quoting the one which is less liquid. So it is less liquid because there are less volumes in it, right?
Volumes will come down.
So your trading volumes will also be lower. So even though you will be best at most of the times, but
Then slippage will be a problem. If you start putting quotes in the liquid one, the non-liquid will create a problem of slippage.
precisely. So if I quote in say, let's assume that Nifty is less liquid and this is more liquid. Okay. So I should quote in Nifty and cover in USD. Okay. Now the thing is that if I'm quoting in Nifty, since Nifty is less liquid, there is less liquidity, there are less volumes, my trading volumes have shrunk, and I'm missing out on a lot of opportunities. So I decide I want to quote in USD/INR, right? So if I'm quoting USD/INR, I'm facing a risk of, okay, I get a fill here, but since this is less liquid, I might face a larger risk of slippage. So I might get a worse price of worse execution price. So okay, so that is where again the statistics comes to your help. That is how will that happen is that you will find out. Wouldn't it be good to know what exactly is causing the movement in the other side? So whether it is Nifty which is causing movement in USD/INR, whether it is USD/INR which is causing movement in Nifty, right? So how will you do that? One thing is you think logically that okay, why will USD/INR fall? Because Nifty is falling. That means your FIs are taking out money. Since FIs are taking out money, they need to get money out of the country, so they are buying dollars, selling rupee. So that's why dollar rupee is coming down. Oh, the dollar rupee is going up. INR is depreciating. Right. Fair enough, but it can be other way around as well. That you have less, the economy rate, the growth rate is falling in the economy. Inflation is rising. That's why the currency is behaving abnormally. So currency is weakening, and that's why FIs have lost the faith, and that's why they are selling in the equities, right? So it becomes a chicken egg problem. So that's where you can use some statistical test called causality test, right? So you can pick some of the tests like branch causality test, and by applying those tests, you can know that at this confidence interval, say 80%, 85% confidence interval, you can say that probably it is Nifty which is causing movement in USD/INR, or it is USD/INR which is causing movement in Nifty, right? So by doing this, if you know the causality, what it means is that what you will not do is that you will be quoting in the leading one. So whichever is leading of the two, because next one the action will follow in the next script, right? In the other side of the pair. So you'll quote which is leading and cover which is lagging. So typically what happens is you choose the pairs which are both are liquid. So there is abundant liquidity in both of them. So you'll just go for whichever is leading, you'll quote there, and that should help you in having substantially lower slippage, right? So this is where you have used statistics, this is where you use statistics, this is where you use statistics or econometrics, whatever you call it. So that's why in this process, the domain expertise on econometrics is very, very important to come up with the new strategies, to establish them, to create model, to build the execution plan.
Okay. You can even take the percentages of the backdated data. You can take the percentages of the backdated data based on for the technical analysis. Take on the ratios. Because normally it is a general tendency of the market, it moves like in a particular.
Yeah. So I'm coming to backtesting now. So the issue we face while we are backtesting coding strategy is, how will you know that when will you get the fill? You're quoting in the market, right? So you are affecting your own strategy by quoting in the market. The market dynamics, the order book dynamics have changed because of your quote. Now someone is seeing that okay, there is this price available. You do not know whether it would be 0.05 rupees above, as in 1 tick above or 10 ticks above. You should be where the other person might have hit you, right? So that is the biggest dilemma for backtesting in quoting strategies. So typically the midway that you take is that you keep on comparing that with the last traded price. So whenever there was a trade at whatever price you are quoting, if LTP was it is better than the last trade price, in that case you assume that you would have got the execution. But still, that is not the foolproof testing methodology. But that is the closest that you have. Or you can have you can run some probability models which will tell you that okay, this is the probability of getting hit at this point of time. So there are different models available for that. There is a lot of research which has gone into it. So we have been working with the clients who are like they used to create most of your engineering background, right? So you might know what half-life is for a radioactive. Okay, but in the science physics you might have heard that for the radioactive substances there is a half-life associated with them. Basically what happens is that for uranium, U-235, that is uranium which you use for making atomic reactors and bombs. So for that there is a half-life. They disintegrate, the radioactivity decays at a rate which is proportional to itself. So say if it is going like 1 है, then half है, then 1/4, so 50% will keep on going down every year, say. So it will be infinite series. It will never be zero, right? So if you want to calculate the total lifespan, so it will be infinite. So you cannot calculate that. So what you typically do is that you calculate the half-life. In how much time it will be half that. That is half the radioactivity will be gone. Right? So what these guys do is that they in fact calculate the half-life of the order book. So when the half the order book would be gone, and accordingly they decide that okay, probably this is where my quotes should have been to get an optimum fill. Right? So there, the idea is to tell you that there are a lot of research papers which have gone through in all these things, which you can go through and learn to know more about what should be the typical quoting testing strategy or typical quoting model. Right? In fact, we do cover some of the research papers which are handpicked by us for better understanding during the course as well. So okay, so I have decided the quoting. Now I do the backtesting. Backtesting I am doing that I can do on the tick data using what I can use is I can use simple Excel. I can use simple Excel. If I am using Excel, the challenge I am facing is that if I am testing it on tick data or tick by tick or even 1 minute for a month or for 2 months of data, it will be like lakhs of data points. So your Excel will go very slow, and it also have a limitation on the number of rows that you have. So for all practical purposes, you will not be able to use Excel as such for backtesting. So that is why we go for R or RXL. So which are much more better in terms of computational power. So you can use that, and you can run them on your servers, and they'll function very nicely, and you will get good backtesting results even on large sets of data. And the good part is that these are open source, so free of cost. Otherwise, you can also use MATLAB, so which comes with a decent license fees. So that's it. But for the trading, especially in the algorithmic trading, typically R or RXL are used very extensively. So you can build your models on that, and then run them through the past data, get the parameters. So next thing would be to set the backtesting parameters. This is backtesting parameters. So what are the backtesting parameters that you look for typically? When you are backtesting a strategy, what are the typical parameters that you look for? Probably one would be the total profit, obviously. Right. Next would be, I guess, the average PL. Sharp ratio, exactly. And that is here the cash line. Sharp ratio is a very recognized thing to judge a strategy in the investment world, or mutual funds or fund performance and everything, right? Now the problem is that when you're doing high frequency trading, you're dealing with the idea of high frequency trading is that you are doing a lot of trades with very minimal margins, very small margins, You're trying to make very small amount of money in a huge number of trades.